How many times can you spend the same dollar? I'll teach you how to spend the same dollar again and again by recycling your money. Where do banks get their money? Answer: from customers who make deposits, just like you. And what do the customers receive in return? Well, they get interest. Not much these days. What does the bank receive? The opportunity to loan the customer's deposits to people who want to finance things. In return, they earn more interest on the loans than they pay the depositors. Banks are able to use the same dollars over and over again to make more money, and you can too. We want to duplicate the bank. Let's examine how the velocity of money, or money being recycled, benefits the bank. As you can see in this slide, we are illustrating 250 car loans being made from an initial capital sum of $5 million. As the monthly payments come in, the bank is able to use that money to make more car loans, an additional 6 after just the first month. And as each month goes by, more and more car payments are being made and can be used to make even more car loans. By the end of the first 12 months, there have been total payments of over $1.6 million, which has allowed the bank to make an additional 72 car loans. And that's just the first 12 months. Every month the bank collects more payments from more loans, and every month the amount of capital available to the bank is increasing. This is the incredible power of the velocity of money. Wouldn't you like to harness that power for your benefit instead of the bank's? I can show you how. Understanding interest rates and the volume of interest in the banking process is extremely important. As you can see in this example, the loan interest rate is 8%, but the volume of interest as a percentage of all the payments made over the loan period is 14.4%. The longer a loan period is, the greater the volume of interest is in comparison to the total of all the payments made, such as in the case of a 30-year mortgage. The volume of interest in this example is an astounding 53.7% of all payments. If you were to refinance this home loan in the 5th year, the volume of interest would be 78.3%. Now, wouldn't it be great if you could be the one collecting all that interest instead of the bank or the mortgage company? Albert Einstein once said, "Compound interest is the 8th wonder of the world. Those who understand it, earn it. Those who don't, pay it." If you understand compound interest and the velocity of money the way the banker does, you can begin to harness that power for your benefit instead of the banker's. There are 3 main players in the banking process: the banker, the saver, and the borrower. Each plays a vital role. Without the saver, the banker has no money to loan. Without the borrower, the banker has no way to earn interest on the saver's money. Without the banker, the saver has no place to safely store their saved money, and the borrower has no place to go to finance the things that they want or need. Let's take a look at how the velocity of money could be used for your benefit. We will begin by assuming that you have some money to begin the banking process. In this case, let's say you have $50,000 that you've saved up. In year 1, you want to purchase a sport utility vehicle for $50,000. You were the saver, now you're the borrower. But as the banker, you insist that the $50,000 be paid back to yourself over the next 72 months at 8% interest. This requires a monthly payment of $877. By the end of the first year, you have paid back your bank $10,524, at which time you decide to purchase 2 four-wheelers for a total of $10,000. You create a loan repayment plan, also at 8%, which requires a monthly payment of $452 per month for 24 months. At the end of year 2, you have $16,472 in your bank. At the beginning of the 3rd year, you want to purchase $10,000 worth of furniture. So you loan yourself the $10,000 and create a payment plan at 8% interest for 48 months at $244 per month. At the end of year 3, you have $25,348 in your bank. By the end of year 4, you have $38,800. Year 5, $52,252, and by year number 6, you have $65,704. You used the same $50,000 to acquire $70,000 worth of vehicles and furniture, and your bank now has 31% more capital than it started with. That's the power of compound interest and the velocity of money working for you instead of someone else. Banks make money several ways. First, by the interest rate that they charge and the volume of interest it creates. They create the velocity of money by continually reloaning the same money and its interest earnings over and over. They get to choose who they loan money to, so they reduce the risk of loss, and they set the terms of the loans that they make so that they can control the interest rate and the volume of interest they collect. If you are your own banker, then all the ways a banker makes money are in your control and work for your benefit. Once you more fully understand the family banking system, I'll show you how you can add tax-free growth, tax-free retirement, and tax-free money to your heirs as additional benefits. I teach people how to create, capitalize, and run their very own family banking system. So, would you like me to show you how you can be your own banker?